Okay, good afternoon and welcome to our first Academy Forum of 2024. I'm Michaela Johns, one of the directors at Hopper Williams and Bell, and I head up the Academy Schools team. So we're at the start of the spring term and I hope it feels positive and fresh. And those of you that got away for half term have enjoyed your breaks. Okay, so onto the agenda slide then, just to talk you through what we've got in store for you today. So first of all, we'll have Alan Davies, who will cover the main points from the 22-23 audits. Then Matt Cooper, who will talk through the changes on the 16 to 19 tuition funds. Then back to Alan to cover some of the benchmarking highlights. And each of you that are clients of HWB already would have received your own personal report to compare yourselves against others in your type of school. Then we have Alan Rolfe with us today, who will look at tax efficient benefits and some of the buy your own device schemes. Then Matt Cooper will cover the latest guidance that's come out on reserves. I will then mention what the National Audit Office does, and then Matt Cooper will cover the professional capability guidance that again came out very recently. We'll finish then with taking you through the timetable just to make sure that you're aware of all the dates coming up for the next 12 months. And as I said, in between we'll have a couple of polls so you can join in and give us your thoughts. So I think we should all note that this year is an election year and that in the latest YouGov poll, education was voted the 8th on the list of voters' concerns for 2024. So let's hope whichever party gets in, some funding is released to the sector and the delays and the changes that have been promised will now start to move forward. So let's hand over now to Alan for our first session.
Thanks, Michaela. Good afternoon, everybody. This is the time of year when we can recover slightly after the completion of all of our Academy School audits and enjoy a bit of a breather before it all starts again this year. And in that reflective mood, we recently had a look back over last year's audit season. We thought it would be useful to summarise the key points. In general, the audits went very well. They were all completed on time, and all of our audit reports were unqualified, although in 4 cases we did include an emphasis of matter paragraph in our report. This draws attention towards a particular disclosure because the auditor considers it to be important to a reader's understanding of the accounts. Last year, we included 2 such paragraphs in relation to Academy Trusts which are transferred to MATs, leaving an empty company which was no longer a going concern. We therefore included additional wording in our report to clarify this. The other 2 cases were in respect of land and buildings. In both cases, the MAT had taken on a newly converted academy and had used an existing local authority valuation of the land and buildings. Due to the timing of conversion, the ESFA had not yet provided a copy of their desktop valuation. Although this is a very basic report, it was the usual method by which the Trust calculated the value of their land and buildings. The emphasis of the matter informed readers that should the ESFA valuation be significantly different, there may be a need to revise the valuation next year. We also issue a report on regularity, and this year we only had 1 qualified report. This was in respect of a catering contract, which included a finance lease. We have discussed this issue before at the forum, so I won't dwell on it too much, but in summary, the issue arises when the contract includes the provision of equipment as an investment by the contractor. Typically, the Academy only takes ownership at the end of the contract and is liable to repay the cost on any early termination. Under accounting standards, this arrangement is a finance lease, which requires pre-approval by the ESFA. So please watch out for this clause if you are changing caterer, and we're very happy to have a look at the draft contract if that would be helpful. We also had some unusual new issues during the audits, and I've summarised these on the next slide. So firstly, we saw an unusually high number of severance payments last year, particularly those with senior members of staff. Thought it might be useful to briefly recap the Academy Trust Handbook requirements. In summary, the ESFA's prior approval is required for special severance payments, and that means those which are non-contractual or non-statutory in three main cases. Firstly, where the proposed payment is for £50,000 or more. Secondly, where the total exit package, including a special severance payment, is £100,000 or more. And finally, where the employee earns over £150,000, excluding employer pension contributions. And all those amounts are based on gross pay. The ESFA's aim with this requirement is to avoid payments being made where they could be seen as a reward for failure, if you like. Trusts must therefore consider whether payments are in their best interest and only make payments where there is a significant prospect of losing an employment tribunal case and where the payments can be justified as being less than the likely tribunal award. In a couple of situations, it wasn't obvious whether the payment was contractual or non-contractual. In one case, the settlement agreement included a payment in lieu of notice. This payment can be treated as contractual if it is calculated based on the statutory notice period per the employee's contract multiplied by their salary. The other case was an instance of gardening leave. This was similar to the notice period, being a contractual period that the employee would ordinarily have had to work, but had been asked not to. So instead of leaving on day one and receiving a payment in lieu of notice, they continued to be employed throughout the notice period, but did not work. And the treatment in this case was similar. So long as the period of time and the pay are in line with the employment contract, then it would be a normal contractual payment. If not, then it would be non-contractual. There is a useful ESFA guide on this subject, and we'll send out the link after the presentation. Academies sometimes invest surplus funds in fixed rate deposits. This achieves a higher rate of interest without significantly increasing the risk. Under accounting standards, a fixed term deposit can be classified either within cash at bank or as a separate current asset investment. The deciding factor is the period of time for which the deposit is locked in. Where the maturity is reasonably short, it is treated as part of cash at bank, and the accounting standard suggests a period of up to 3 months would be treated this way. Conversely, a fixed rate deposit with a maturity of more than 3 months would be shown as a separate investment. A point of confusion is at what point in time is this maturity assessed? Is it at the point of making the deposit or at the Academy's year end? As the deposit approaches maturity, would the classification move from an investment back into cash? But the answer is that the classification is determined at the point of investment. The amount of time between the investment and the year end doesn't matter, and the classification doesn't change as the deposit approaches maturity. This may sound slightly counterintuitive, as, for example, we're used to seeing the classification of Salix loans change between short-term and long-term over time. The reason for the different treatment in this case is that accounting regulations have a different basis for the definitions of assets compared to liabilities such as loans, which are based on the earliest date a lender can require repayment. Although this is an accounting technicality, it is one which can have a significant effect on the cash flow statement. Turning now to land and buildings, Academy trusts are familiar with the concept of including the value of the land and buildings on the balance sheet, even though the usefulness of this information to a user of the accounts is arguably quite limited. However, it's not always clear whether the land and buildings should be recognised as assets or not. In a lot of cases, the Academy's land and buildings are occupied under a long-term peppercorn lease from the local authority. However, the land and buildings for church academies are often owned by the diocese. In these cases, the Academy occupies the building under a licence rather than a lease. The licence to occupy is usually on a 2-year rolling basis. In these cases, recognition of an asset is dependent on the extent that the Academy has control over access to the building, also whether the Academy has control over works. Where the Church has an ultimate right to determine access or to consent to works, the land and buildings are not recognised as an asset. Now, you might think this makes the accounting a lot simpler, but I'm afraid you'd be wrong, because although the land and buildings are typically occupied on a 2-year rolling licence, the accounts direction concludes that this is similar to rent being paid in advance. The Academy's occupation of the premises for this 2-year period is therefore recognised as a notional rental expense, together with a notional donation, since of course it pays no actual rent. And it gets stranger, as the Academy should also bring in a matching asset and liability for the future notional rental and donation in respect to the 2-year period to come. This can have quite a distorting effect on the accounts, as although there is no effect on reserves, the accounts will include income and expenditure and assets and liabilities which are notional, which will never be paid or received. I will now touch very briefly on the subcontracting of education, since it only applies to post-16 provision. Subcontracting occurs when learning programmes are delivered by a third party. The ESFA have detailed guidance which should be followed if a provider wishes to put a subcontracting arrangement in place for the first time. An external auditor's report is required to provide assurance on the systems and controls that are in place for subcontracting. There is additional guidance on ongoing arrangements. Please be aware of both sets of guidance if this is an area relevant to your Academy Trust. Just a brief update now on the holiday pay issue which arose from the Harper versus Brazel case. This involved a music teacher on a permanent 0 hours contract. The teacher received holiday pay on a rolled up basis, equating to approximately 12% of her earnings. The teacher asserted that she was due holiday pay for the statutory minimum of 5.6 weeks based on earnings over the past 52 weeks, ignoring any weeks in which she did not work. And the conclusion of the case agreed with her and found that all employees are entitled to 5.6 weeks of annual leave, regardless of irregular hours or how many weeks per year they work. Following the outcome, the government issued a consultation of changes to the current system. That consultation has now concluded, and the government has legislated to reintroduce a system of rolled up holiday pay using the same 12% method, and this only applies to irregular hours workers and part-year workers. So effectively, we're back to where we started with this one. And the government has now published guidance on how to implement the new rules, which apply from January this year, and we'll send out a copy of that link after the presentation. And finally, last year, we again saw a significant reduction in the value of local government pension scheme pension deficits. And on average, we saw the value of deficits pretty much halved in 2023 compared with what was reported the year before. And that was because of a further increase in the discount rate assumption, which was driven by higher interest rates. As in the previous year, in some cases, the reduction was so great that it resulted in an overall pensions asset rather than a liability. This was because the Academy's share of the assets in the pension scheme exceeded the estimate of its liabilities to pay pensions in the future. Under accounting standards, a pension asset can only be recognised if it is recoverable, for example, through reduced contributions in the future. As the fluctuations in assumptions were projected to be relatively short-term, we did not anticipate that contribution rates would reduce. In these cases, we recognised a nil balance rather than a pension asset. Based on what we've heard from the National Audit Office, our approach was in line with that taken by other firms. And just to conclude on this one, it's worth noting that the August 23 figures have no bearing on future LGPS contribution rates, and they're just purely for accounting purposes only. As in previous years, We've also summarised the key issues from our audit findings reports. On the next slide, I've set out a summary of the number of issues that we typically recorded. Generally, we saw a slight reduction in the number of points raised. On average, we reported around 4 to 5 financial statement issues and 3 to 4 regularity issues. We tended to raise less high and medium priority points compared to the previous year, and in addition, only 2% of all of the comments related to high priority issues which had not been resolved from the previous year. So in summary, that's a welcome improvement and shows that trusts are making good progress at resolving high priority issues and improving systems and controls. So that concludes my summary. Please let me know if you have any questions. I'll now hand over to Matt, who's providing an update on 16 to 19 tuition fund.
Perfect. Thanks so much, Alan. So on this slide, I'll be providing a brief overview on the 16 to 19 tuition fund and updates on this area which have arisen this year. So the 16 to 19 tuition fund is specifically allocated funding for all 16 to 19 institutions who receive annual funding allocations from the ESFA for the provision of 16 to 19 education. It was originally established as one of the DfE's measures during COVID to help mitigate the disruption of learning. So due to this, as I'm sure you're aware, this funding is currently in place up until the end of this current academic year. And the DfE is evaluating the tuition fund and considering the most appropriate way to support disadvantaged 16 to 19 students from the 24-25 academic year onwards. Any extension to this fund would be a change of policy, so we're not expecting one, but with the potential change in government looming, who knows really. So in terms of timeline, so auto renewal for 23-24 would have been the most likely, as this would have happened if you received funding in 22-23 and completed the previous end of year reports. This year you would then have completed the in-year spend form, which had to be completed and submitted by the 31st of January just gone. So this was to identify how much tuition funding had been spent from September to December last year and forecast through to the end of August this year. So the final return for 23-24 is the end of year report form, which will need to be submitted by the 31st of October. So this consists of completing a declaration of expenditure for the 23-24 academic year, confirming that the costs met funding conditions and are accurate. The ESFA also expect you to ensure that eligible costs were incurred by the 31st of August and to promptly return any surplus funding. So they do complete their own internal assurance work, the ESFA do, on these returns. So if you're one of the lucky ones who get sampled, then they may be in touch with further queries or to request evidence of invoices, etc. The DfE have yet to confirm when this end of year report form will be available, but they tend to allow about 4 weeks, so likely to be released at the beginning of October this year. In terms of funding, so for the 4 years between 2021 to 23-24, the DfE provided funding of up to 420 million for the one-to-one and small group tuition, which had aimed at enabling schools and colleges to deliver up to 700,000 tuition sessions per year. Actual funding allocation payments to individual institutions commenced at the start of the 23-24 academic year for those who automatically renewed. And these allocations are still based on the same 2 proxy measures, first being for students with low prior attainment, meaning those who did not have a GCSE grade 4 or above in English and/or maths at age 16, and second being for students from the 27% most economically deprived areas of the country. So like we did previously, now that the in-year spend forms have been submitted, the ESFA will review and consider if any institutions are able to have their funding increased. If there is any scope for this, then this will only be for providers who have submitted a return and are forecast to spend 100% of their allocation already, and will contact relevant institutions in due course. In terms of eligibility, so all institutions that receive annual funding allocations from the ESFA for the provision of 16 to 19 education with students that attract disadvantaged blocks 1 and 2 funding are eligible. All students must be on a 16 to 19 study programme or T-level, and the funding should be used to support tuition above and beyond what is already set out in the planned educational activity of the programme. When identifying who needs support through the tuition fund, you should prioritise students who have not achieved a grade 4 in GCSE Maths and or English in the first instance, and also the fund supports students that meet eligibility requirements in small groups and one-to-one tuition. And by small groups, the ESFA suggest that these are up to 5 students, preferably less, and must not be more than 7. It also covers tuition in English, Maths and other academic subjects, along with tuition in non-academic subjects, such as exam prep, and tuition in vocational courses too. In terms of eligible spending, so you may use up to a maximum of 10% of your tuition fund spend for direct costs to deliver tuition in addition to actual staff costs. So the ESFA have set out a list of eligible direct costs, which include room hire, where there is a need to hire rooms from a third party, attendance management, materials necessary for delivering tuition support, costs incurred due to short notice cancellation of a session, and preparation time for delivering tuition. So that means that the remaining 90% of the fund is to be used for actual staff costs to deliver catch-up tuition or the costs of contracting to a third-party tuition provider. So that's everything for this update on 16 to 19 tuition fund. If anyone has any queries, again, please do get in touch. I'll now pass over to Michaela, who's going to do a quick poll on sixth form funding as well. Thank you.
Thanks, Matt. So just to recap for any of those that have arrived late, we're doing a little bit of participation this time on our forum. So do go and log into the web browser and put slido.com in, either on your computer or on your phones, and then put in that number 3651447, and then you'll be able to join us with the rest of the attendees in telling us what's happening in your sixth form. I'll leave you just for a few seconds to complete that, and then we'll see what everybody's answers are. Obviously, I realise that some of you are primary schools and therefore it won't be applicable, but it's just useful to know whether you're alone or whether you're the same as everybody else in our client base. I think we can see about 14 of you have voted so far, so I don't know if the IT is a problem at all, but from that we can see at the moment out front is that sixth forms are appearing to make a loss, which is an interesting answer. I think the DFE's guidance is that your sixth forms should be, you should be planning to make them break even, so that they don't eat into the funding that you're receiving for your 11 to 16-year-olds. And you should have a plan over a period of 3 or 4 years in order to try and achieve that. I know from experience that's really quite tricky. But, I think from what we're seeing here at the moment, I think you're probably finding the same. So quite an interesting poll. All right, I'll move on now and pass you back to Alan to cover benchmarking.
Thanks very much. As Michaela mentioned, we use the data collected during the preparation of our accounts returns to produce a free of charge benchmarking report for all of our Academy clients. While it is a relatively small sample size, it is a quick off the press summary which looks at a small number of key performance indicators. We issued this year's copy at the end of last month. We've also prepared a 2-page summary of the key figures, which we'll send out after the presentation. So just a few highlights from this year's edition. Firstly, most of our Academy trusts recorded an in-year surplus, and that's excluding the effect of any capital grants and the movements in the local government pension scheme. And that continues a trend from last year. We saw a welcome increase in grant income per pupil of around 9%, and non-grant funding, although accounting for a relatively small proportion of total income, rose at a higher level of around 20%. However, income from facilities showed a slight reduction from last year, perhaps indicating that some academies could generate some additional income by increasing lettings. Looking at expenditure, key expenses were generally in line with the previous year. Expenditure on staff costs as a percentage of total costs fell slightly by around 1 percentage point to 79% at primary level and 78% at secondary. And again, that's excluding the effect of the local government pension scheme accounting. Turning to non-staff costs, energy costs showed further increases in 23, as would be expected, increasing by around half a percentage point for all trusts on average. Looking at the financial position, we've recently seen increased focus from the ESFA on trusts which are holding significant levels of reserves. We're going to cover this in more detail later in our presentation, as on average, we saw trusts holding between 15% to 20% of their annual income as reserves. This was similar to the previous year and amounts to around 2 months of expenditure. And finally, we've seen an increased number of trusts adopt the standard DfE Academy Chart of Accounts. This year, almost half of our academies had adopted the new chart. Please let me know if you have any questions. I'll now pass over to our other Alan to talk about VAT.
Thanks, Alan. I'd like to cover a few different topics here, but I'll start with VAT. The good news is that there hasn't been much in the way of changes lately on VAT, but one useful development which may not have been picked up is that from the beginning of this month, any relevant charitable purpose organisations can benefit from 0 rating on energy saving materials. Now, relevant charitable purpose organisations we normally think of as charities, but of course academies are automatically deemed to be a charity, so fall within this category. So what does this mean? Well, it means that if you're having work done on the school to do with insulation, but also fitting things like heating controls, solar panels, wind turbines, heat pumps, wood pellet burners, any of that equipment will now benefit from 0 rating. And it's important that your contractors, if they're working on school buildings, are aware of this. While, of course, you normally recover VAT, the revenue could, if they were picky about it, insist that you go back to the supplier to say, no, you shouldn't have charged us VAT. And so that could cause some problems. So it's important to watch out where you're having any works done on buildings that might include insulation or fitting of heating supplies, etc. Just to be aware about this change. Obviously, if you've got any queries, you can always fire a message over to me and we can sort out what needs to happen there. Otherwise, on the VAT front, it's been fairly quiet. We're obviously waiting to see whether the general election gives a new government some impetus to make material changes to the rules, but I'm not expecting anything significant at the moment. So on to some tax issues, and I'd like to just briefly talk about schemes to buy your own device, such as a laptop. These are sometimes undertaken to provide a cheaper way for pupils to have access to IT equipment, and the revenue's view is that those type of schemes will be a business activity for the school if the equipment is not 100% essential for the delivery of education. Now, what that means is, from a VAT perspective, that if it's an optional scheme where people can choose whether or not to join it, then VAT will be due on the amount charged for the equipment, matched by the VAT recovered on the purchase. So that doesn't really gain anything from a VAT perspective. However, if you have a scheme where the pupils are required to use the equipment for lessons, and perhaps people that can't afford to participate are provided with a free machine, a loan machine or something like that, then there's a chance that it might qualify as being core educational non-business activity. And this has the benefit that VAT is not charged on any money you charge to the pupils and parents for the equipment, while the school can still recover the VAT on the machines themselves. So that can be quite cost effective for everyone concerned. But as I say, this has got to be a situation where the equipment is essential to the delivery of education. The revenue are behind the times in understanding about IT. They don't realize that laptops and the like are very core part of the delivery of education. Their guidance is still based on historic norms where it was a blackboard and a piece of chalk. So we do have to sort of nudge the revenue sometimes to remind them that the world has moved on a little. On a practical point of view, we need to be careful that if you're operating a scheme for, say, members of staff to purchase laptops, this could be taxable as a benefit in kind if the machine is provided as an undervalue. And also we need to be wary that we can't use what's called salary sacrifice arrangements to provide a discount to staff either, because the rules were changed a few years ago, 5 years ago or so. We're no longer able to include computer equipment as part of a salary sacrifice, and that could trigger a benefit in kind tax charge if sacrifice arrangements are in place. So a bit of care needed there. On a practical level as well, we need to watch out about the type of arrangement to acquire the equipment. As has been mentioned before, leases are something that the DfE gets concerned about, so we need to make sure that you're operating in the right way on that score. And also you need to consider from a commercial and risk point of view what the position would be is if someone didn't fully pay for their machine, or if a pupil leaves the school not having paid for the machine. Again, I'm sure you'll be well aware of those risks. So further tax issues to think about, particularly in terms of motivating and retaining staff, are perhaps to consider whether we can offer some tax efficient benefits in kind to people. One of the slightly newer options is what's called trivial benefits. These allow individual benefits of up to £50 at a time to be given to staff. It could be a voucher for a shopping, or it could be a physical asset, something like chocolates or food, or a voucher for a meal or something like that. The condition to make these tax-free is that they're not provided in reward for particular services. So you can do this as a general thing. So you might choose, the school's been done well at Ofsted, so everyone gets a voucher, or we've received some positive feedback, but it's not directly as a result of a member of staff's work, so we're able to give out vouchers. You can do it for weddings, for children, for birthdays, all sorts of things, and you can give out any number of £50 awards. So there's quite a lot of flexibility there for the smaller things where you want to reward staff. You can't hold it out as, if you do this activity for school, we will give you this voucher as payment. But if people have gone above and beyond, you might choose to offer them a non-contractual but still nonetheless welcome trivial benefit award. Long-serving staff can benefit in a similar sort of way. The conditions there are it's £50 per year of service with a minimum of 20 years. So once a member of staff's done 20 years, they could be given a long service award of up to £1,000. And that would again be a non-cash payment to them, so it could be a shop voucher or a physical gift, and that can be quite a nice way of recognising longer serving staff without incurring a tax charge for them or incurring PAYE obligations for the academy itself. Cycle to work, something you're probably aware of, is an arrangement where the academy contracts to provide a cycle to members of staff. They can pay for that by way of salary sacrifice, so it doesn't cost the academy anything, but from the member of staff's perspective, it's cheaper because in doing a salary sacrifice, they're effectively getting tax relief for purchasing a bicycle. So that can be quite tax efficient. You just have to watch out that when they eventually receive ownership of the cycle, because initially the cycle is owned by the academy, but can be given to the member of staff later down the line. There's a very small, modest benefit in kind at that point, but that can sometimes be avoided if the cycle's held for long enough. But even so, even taking that into account, it's very cost-effective way for someone who wants a cycle to acquire one. The final tax efficient benefit I just wanted to touch upon was that if someone perhaps is struggling financially, it's possible for the academy to make a loan to a member of staff. Any amount up to £10,000 will escape a benefit in kind, and that can be quite a nice option if you think of someone having a temporary financial concern that they want help with. So that's something to think about as well. It's just a matter of thinking at these range of benefits and picking out the ones that might be of most help. So that's really a quick whistle-stop tour through a few tax things, and I'll now pass you over to Matt to carry on the presentation. Thank you.
Perfect. Thanks, Alan. So, yeah, for ESFA released a good practice guide with regards to Academy Trust reserves back in November last year, which is something the sector's been asking for some clarity on for some time, both from yourselves, but also from us as external auditors, in order to provide some guidance to the sector. In general, it gives some useful explanations on the basics, which could be helpful for non-finance minded trustees, and also some good food for thought, which you can then compare your trust against. It falls short of prescribing a required level of reserves, which is a good thing, since there are so many variables between different trusts as to what level is right for them at any given time. So today I'm going to run through some of the main areas from this. So to start with, what are reserves? So in short, they are an accumulation of all unspent funds from previous years which have been received by the trust. These are split down further between the two main types. So unrestricted, for example, unspent facility hire income, which can be used at the discretion of the trustees, and then restricted, for example, unspent gag income, which remains restricted in accordance with the conditions of the grants. As for regulatory requirements, as part of financial planning, the Academy Trust Handbook, the ATH, requires trusts to have a reserves policy in place, which I'll touch on shortly, and also be able to explain this policy in their annual financial statements. This is an important part of trustees' financial and strategic responsibilities and forms a vital part of their oversight and risk management of the trust. The Academy's Accounts Direction, the AAD, goes further and stipulates what information trusts must include in their financial statements about their reserves policy. For example, explaining the level of reserves identified by the trustees as being appropriate and the reason for holding them, i.e. what the plans are to utilise these. So what options are there? So Academy Trusts have the freedom to establish governance and financial management arrangements that meet the needs and circumstances of their vision, values, and the Trust's academies. Within this, there are choices for trustees about how the trust can get the best value from their resources and where MATs can achieve economies of scale and other efficiencies. So these options include pooling funding at different levels, depending on the trust's governance structure and financial scheme of delegation. Some MATs take a top slice from the GAG for central services, and pass the rest on to the individual academies. Some trusts bring the GAG into a pooled central fund, while others pool reserves in a central fund, expecting each academy to contribute for an in-year surplus each year. Therefore, this allows MATs to retain the ability to direct funds and resources across the trust in accordance with need, including using reserves to address priority investments across their schools. Trusts need to be transparent in their decision making and reporting so that parents and other stakeholders are reassured that each school is benefiting from the funds allocated to its pupils. So there are 5 main areas that the ESFA have highlighted that trusts need reserves for. So just going to go through them. So first is cash flow, enabling the trust to manage fluctuations in income by ensuring sufficient cash is available to pay bills and expenditure items as they fall due. Also a minimum level of trust reserves, so setting aside a contingency basically. So this amount is to be able to cover any unforeseen issues or extra costs in year. This could be to balance budgets where in-year expenditure exceeds income. There's also capital projects, so growing reserves to enable maintenance, development and improvement of the trust's infrastructure to deliver the trust's capital and estate strategy. And there's also development and growth, so providing for the trust's financial health. This could include preparing for new schools to join the trust, for existing schools to expand, training for staff, or investing in the central services of the trust to improve delivery or increase capacity. And finally, future change and uncertainty. So, for example, on this one, planning for a period of reduced pupil numbers or covering unexpected costs to ensure the trust's overall budget is balanced. The guidance then goes on to suggest that there are 4 main areas which should be taken into consideration when trustees are deciding on what level of reserves is appropriate for your trusts. So firstly, the size of your trust, as that will clearly have a large effect on how much might be needed. For instance, single academy trusts tend to hold a higher proportion of income as reserves to cover emergencies, whereas larger MATs may in total hold more reserves, but as a proportion of their income tends to be lower, as they may not need to hold a contingency amount to cover every school, as this risk could be perceived to be low if all schools were to experience difficulties at the same time. The trust's estates strategy is also key, as having plans to manage the estate and premises will help the trust deliver its educational goals and will identify priorities for the trusts to ensure its buildings are safe, operationally efficient, and enable pupils to succeed. The trust's future plans are important, as if the trust is planning on supporting new schools joining the trust, then appropriate reserves may be required for this. And then also upcoming risks and opportunities. So as part of the financial planning for the trust, school leaders may identify a change in pupil numbers that could impact on funding, either an increase in a future year that would draw on resources until lagged pupil funding was received, or a drop in pupil numbers that would reduce future income. So here reserves can provide extra support for a trust to see through these challenges while it adjusts to a new pattern of funding. Similarly, there could be bidding opportunities for capital funding that may require a reserves contribution to be made to help secure funding and deliver improvements. So what is key from this guidance really is that trusts need to strike the right balance between holding sufficient reserves to ensure the financial health of their schools and the ability to fund significant future investments without holding back too much that could otherwise be used to benefit pupils. So as mentioned earlier, a reserves policy is one of the ATH musts, and trustees are required to maintain oversight of this policy on an ongoing basis to ensure it remains fit for purpose as your trusts continually evolve and change over time. So a few areas which should be considered within your reserves policy include the minimum level of reserves the trust expects to hold, how funds will be managed until project delivery, the process for confirming the trust's strategic and investment priorities, the plan for any long-term projects that require substantial capital, the process for using reserves to balance in-year budgets, what steps the trust will take to manage risks around any pension fund deficit, plans and timeframes for reviewing the policy, and for MATs, this should also set out how individual schools within the trust can access funds and arrangements for the treatment of any surpluses they may generate. The guide also goes on to suggest a few areas that the trust board may want to consider. So this could help generate some discussion at board meetings. So a few of these are what reserves are readily available for use and how much is tied up in other assets. Are there any future commitments that need to be considered? If funds are not needed now, how can they be invested to generate some extra income for the trust? And what are the projected pupil numbers for the next few years? So the £1 million question, what level of reserves are right? As mentioned earlier, there's no one-size-fits-all approach here, as it will vary between different trusts of different sizes in different areas. Having said this, the ESFA has set a couple of benchmarks which they say tend to be the maximums and minimums where they focus their time on. So they say around 90% of trusts hold reserves of at least 5% of their total income, and many of these use the ballpark of 1 month's costs as a benchmark. So that would equate to around 8%. On the other end of the spectrum, trusts choosing to build a high level of reserves, defined by the National Audit Office as 20% of total income or more, generally do so because of specific needs, such as capital projects or growth plans. So like Alan covered on his benchmarking update earlier, we can see various trends in reserves from our client base. So as expected, for a vast array of different reasons, the level of reserves does vary significantly from around 3% up to 58%, averaging at about 14% for secondary and 21% for primary. Finally, to conclude on the ESFA's role in this current economic climate, they say that they review trust reserves to help identify financially vulnerable trusts as part of their programme of works. So where trusts have low or declining level of reserves, the ESFA will contact the trust to understand its position and discuss any potential support that may be appropriate. So this tends to be at a level of 5% or less. Then on the other end of the spectrum, where trusts have reserves of 20% of total income or above, the ESFA will consider this position alongside the trust's specific context and are likely to seek further information from trusts about their plans for these substantial funds, gain assurance that a policy and clear plans are in place, and that these funds to meet people's needs and ensure compliance with ATH. So at both ends of the spectrum, the most important aspect really is to be able to justify why your trusts hold the level of reserves that it does, as if they're high, the ESFA may question why the funding is not being used sooner for the benefit of pupils, or if they're low, the ESFA may question what further can be done to bolster the trust's reserves position. So I hope this has been a useful summary on the ESFA's new good practice guide. And of course, if anyone has any queries on the reserves, please do reach out after today's session. So I'm now going to move into a quick poll on the next slide to get some ideas and trends across today's attendees. As Michaela mentioned, it's completely anonymous, and we'll be able to share the results when we circulate our slides following today's webinar. So what level of reserves would you say your trust currently has? We've got a few options. Hopefully it will cover off the answers which you need. So we've got about right, not enough, too high, or also added not sure. I'll just go quiet for a few seconds to allow everyone to have a quick think and cast their vote. Okay, so we've had about 19 people vote, so that's pretty good. And yeah, so biggest vote so far then is about right. So that's quite promising. It would indicate that kind of you're all on top of your reserves policies, aware of future plans to utilise your reserves, and probably have been doing so for some years, and probably aware of the good practice guide already. So yeah, like I said, quite promising. Obviously, the second highest one there, not enough, is probably unsurprisingly expected in the given economy. So yeah, okay. Thanks very much for that. And I'll pass you over to Michaela for an update on the National Audit Office. Thank you.
Thank you, Matt. Yeah, I think that poll was quite telling actually, because I think depending on which part of the country you're in, you may well get very different results further north you go, where reserves are woefully low. So just a quick reminder then before I launch into this part of the seminar. please do put any questions that you have for what we've covered already into the chat box, and we'll see if we can answer them as we go along. So this part of the seminar was just to warn you about the National Audit Office and the work that they do. Many of you will not as yet had any contact from the National Audit Office, but I wanted to make you aware of that in case it happens to you, so you're prepared. So every year, the National Audit Office contact a selection of external auditors that they want to talk to because we act for one of the Academy trusts that they have chosen in their sample. Their sample then feeds into any issues arising during the course of their national audit of all the Academy trusts. They audit the consolidated position of all of you together, and so they want to know what the local issues are down on the sort of the ground, rather than at the big national picture. And so we as auditors feed into that for them. So what will happen is they will ask us to release our audit files to them so that they can then talk through any issues. So for the year to 31st of August 22, the issues that they wanted more information from us as auditors on were around embedded leases. And Alan Davies mentioned that at the beginning, that we had a couple of qualifications of the regularity report again in this year to 23, but they were more prevalent in 22. And also the year to 22 was the first year where we saw the pension scheme deficits turning into some cases into assets. And again, from a national position, they weren't really aware of that until they spoke to us as external auditors. So if you are chosen, we will of course contact you and ask your permission to discuss your audit with the National Audit Office, and ask you to confirm that to us in writing. You will have been chosen by them based on size, maybe location, the composition of your MAT, whether you have high funding levels of SEN, whether you're a free school, primary, secondary, if you have a sixth form, whether you're a faith school, whatever their sample selection is coming up with. And so once the National Audit have completed their national work, they publish what is called the SARA, S-A-R-A, and that stands for the Sector's Annual Report and Accounts. And that runs to the 31st of March, like state schools, and not to the 31st of August, like academy schools. And that's why their inquiries are slightly out with the timing of your year ends. So I hope that just running through that has taken out the scariness of the process in case you are chosen, and it's good to know that it is normal practice and it's just bad luck that you've come up in their sample for the year. But hopefully that won't take too much of your time. I'm now going to hand back over to Matt to cover professional capability.
Brilliant. Thanks, Michaela. So yeah, back to me for my third and final slide. So on this slide, I'll be running through another report which was published by the ESFA last year in December. This was titled Building School and Trust Business Professional Capacity, and includes an update on the latest evidence around the financial business capability of the sector, the impact of the ESFA's current support, and also their next steps, which I'll summarise today, which will hopefully provide some food for thought. So the DfE's aim here is for every school and academy trust to be led by those with the skills, knowledge and capacity to achieve excellent school resource management. So in terms of the skills needed, these decisions are the responsibility of your trustees and kind of you as trust leaders, financial professionals, as your best place to make these decisions, as you know what skills and knowledge are required within your own trusts. The DfE states that their role here is to support you in achieving these aims. So They've outlined that there's over 10,000 school business managers across the UK and nearly 7,000 finance officers. So from a finance perspective, this is a substantial workforce, so it's important that everyone has the right level of skills. These roles, in addition to CFO roles, have been the initial focus of the DfE support for capability to ensure strong and robust financial management across the sector. It reports on both skills and knowledge gained for experience, and also professional qualifications such as ACA, AAT, and various diplomas available. The ATH states that CFOs and other key financial staff should maintain continuing professional development, so CPD, and undertake relevant ongoing training, which is also a condition of their relevant institution, such as the ICAW or ACCA. So this is an important part of maintaining and developing knowledge and skills to be proficient and competent in their roles and enable them to adapt to change, which is an important aspect when working within this sector. The report also highlights other job roles such as premises managers, office managers, and IT managers, being three further important professional roles within the trusts. So in terms of who this covers and who this report is aimed at and where the professional capability is required. So first and foremost, school and trust business professionals to allow awareness of how the DfE is investing in professionals' capability and sources of further support. Also for trustees, so for awareness about professional development options for employees, and also providers of school and trust business professional development to provide information to help inform their own product and service development. The DfE had evidence that uptake of CPD was not always sufficient, and therefore they have a fully funded sector training bodies to provide SRM webinars with the aim of ensuring that there is a universal minimum CPD offer for all school business professional roles. There's also a mentoring program for CFOs and COOs in order to build skills and knowledge required in this role. So the report states that about 75% of CFOs who have completed this mentoring scheme to date have implemented changes or improvements in their trust's processes as a result of being mentored, of which 2/3 said this has or will result in monetary savings. So examples of changes included increased use of metrics analysis, improvements to risk registers and reporting to trustees, and more informed budget setting. The DfE are also piloting contract management training developed by the Cabinet Office at two different levels, so for foundation and practitioner. This, they say, is to ensure that there is a way for professionals responsible for contract management and procurement of different scales and complexity to access the training they need from low level to increasingly larger and more complex procurements. So between 21-22 and 22-23 academic years, the DfE piloted a targeted bursary programme for 31 new or aspiring CFOs in trusts to test the suitability of qualifications supporting them to acquire skills and knowledge for the role. So there's also now a similar pilot scheme for school business managers too in schools to test the suitability of the level 5 qualification in helping to prepare school business managers to carry out school business leadership responsibilities and or in being prepared for career progression into more senior leadership roles. The DfE has outlined that it has further intentions to build upon the support, which it calls its next steps. Some of these ideas are to continue to fully fund online SRM webinars in 23-24 across a range of financial, business and operational modules. Continue to provide a small number of targeted bursaries each year for new or aspiring CFOs in academy trusts that may not otherwise be reasonably expected to prioritise or fund such professional development. Explore how to improve uptake to high-level qualifications offered on the market and ensure these are fit for purpose. Continue to fund targeted mentoring relationships for less experienced or new staff to learn from experienced peers. This is being delivered as part of the SRMA programme for 23-24. Make contract management training developed by the Cabinet Office available to school and trust business professionals free of charge. And finally, work with professionals and sector organisations to explore launching an SBP training directory, so professionals have a live view of which sector organisations offer professional development support. So hope that's been a useful update on this report. And again, if anyone has any queries on this, please do get in touch following today's session. Thanks very much. And now back to Michaela. Thank you.
Thank you, Matt. Before I launch into this next slide, I'm just going to cover off a question that's come up in the chat box. So I'll just repeat it for everybody. Would be interested to understand the financial positions for 23-24 as a look forward. 22-23 was a surplus for most, but is that replicated in 23-24? I suppose from our perspective, I know Alan Davies has been involved quite heavily in some of your budget forecast returns, which will have that sort of information of predictions. But as we know, when those budget forecast returns were done, the announcements that came following have probably completely changed those predictions now. I think the general feel that we have is that it is getting tighter. There are less surpluses and smaller surpluses, but I think very hard to answer that on today's call, but we'll be in contact with you to discuss that on a one-to-one basis, if that's helpful. Okay, so I'll just cover for you the key dates for the next 12 months. So we've got a couple of weeks now before your school's resource management self-assessment tool needs to be in on the 15th of March. Many of you may well have already submitted this. It was released quite early and therefore that could already be in. But again, one to get your trustees involved in on signing off. Submission of your accounts to Companies House. Again, the deadline is the 31st of May. We tend to file them as soon as you've signed them, so they tend to go in very early January. So I believe that all our clients are already filed. And then we'll be back into the teacher's pension, end of year audit and returns, again, 31st of May. For the return to be sent in by yourselves, and then the audited version by us on the 30th of September. In between those two, we've got the budget forecast return. The date for that hasn't yet been published, but we're assuming it's going to be the 23rd of August, but we'll keep an eye on that and put any updates on that date out on our Academy newswire that we send round to you all. Again, we've put on there the land and buildings collection tool, a similar date to last year. Again, not for certain, but we'll firm up on that at some point. Just wanted to maybe give everybody a little bit of a heads up on the land and buildings collection tool. Not a lot of work has been done on that by auditors in the past. But there has been a few rumblings from the ESFA that some of the information on there, it may not be as accurate as it should be. And therefore, I feel that we can see that coming down the line, that we might be asked to look at that in more detail. So just wanted to give you advance warning to have a good look at that and make sure that your submission in November 24 is as accurate as it can be, because we may well need to report on that in the future. And then the financial statement and audit findings report deadline will be, as you'd expect, 31st of December 24, and then the Academy's accounts return 28th of January 25. So yeah, a little way away yet, but good to have that all in one place. So we thought we'd do just a final poll for you all to try and understand what you might like us to cover in future sessions of the Academy Forum. And so the question that we're putting to you is, what is going to be your focus for 24-25? What are you going to spend your time on this year? What are you going to be managing? So do just literally, you can type in a word on this one. This is slightly different to the other one, so you can have all sorts of answers. You know, we've got coming up here working on your estate, so I presume that means making sure that your buildings are, you know, the green initiative fit for purpose and safe, you know, all those sorts of things. It's good to just know what everybody is working on. So you can put it in more, you know, more than one thing, so that we know that what the topics you might like us to cover, that you might like some input on going forward. I'll leave that running, but we hope today's session has been good and has given you an update, and some of the polls have shown you that you're not alone in the various topics that we've covered. If you would like to sign up for our monthly Academy newswire, then please do drop us a separate email, and we'll make sure that you get onto the mailing for that. The next date of our forum is set as the 18th of June, and this one will be in person. And this time we're going to hold it in Totton, which we hope gives you good quick access from the motorway and should mean that it's easier for our clients who are also in Wiltshire and Dorset to join us. And then the one following the June one has been set for the 26th of September, and we expect that one to be back online again. Yeah, please continue to add to the topics. It's all great to know what you're going to be focusing on. Also a date for your trustees to put in their diaries. We run an annual update session, and this has been set for the 10th of September. All of these can be booked on our website, and I know many of your trustees have already booked that one because that date's been up for a little while now. So that leaves me just to say next week or end of this week, we will send out the slides, the recordings and the links that we've mentioned to the documents, so that you can then send them on to anyone in your Academy Trust who couldn't make it today. I hope that the rest of the week is kind to you, and I look forward to seeing you all in June. And you know, please do make any suggestions. We know that there are a few new things coming up. The Procurement Act 2023 will come into play in October this year, so that might be key for a few of you that we might want to cover in our next forum. So I'd like to thank all the speakers today, and thank you all for attending, and look forward to seeing you soon. Thank you. Goodbye.